Zillow just slashed their 2025 home price forecast from positive 2.9% growth to negative 2%, the first predicted annual decline since 2011. In Michigan alone, 31.3% of all home listings are now experiencing price cuts, up from just 26% last year, while Indiana sees a staggering 42.8% of homes dropping their asking prices. Look, we're about to show you data that most real estate agents don't want you to see. We're talking about 3 critical shifts happening right now in the Midwest housing market that could save you tens of thousands of dollars if you're buying, or cost you that much if you're selling at the wrong time. And stick around because we'll reveal which specific Midwest city just saw luxury home prices crater by 17.2% in just 6 months. And why Wisconsin, yes, Wisconsin, is actually bucking the entire trend, with one city seeing 20% gains while everything else is falling apart. But here's what the data reveals that nobody's talking about. We now have 500,000 more sellers than buyers nationwide, according to Redfin's latest report. The highest imbalance on record. Think about that for a second. Have you noticed more for sale signs staying up longer in your neighborhood? Because this isn't just a feeling anymore, it's mathematical reality. The Midwest lost over 400,000 residents to other regions between 2020 and 2022, according to the Council of State Governments. And that exodus is finally catching up to home prices. But before we show you which markets are getting hit the hardest, you need to understand why even cash buyers with deep pockets are starting to pull back. Here are the 3 markets showing the most dramatic shifts, and number 2 is going to shock you because it's happening in a state everyone thought was recession-proof. Number 1, Detroit, where median home prices sit at just $180,000, making it the most affordable major metro in America. Yet inventory is piling up with a 16.9% surplus of sellers over buyers. Number 2, and this is where it gets interesting, Chicago's Gold Coast luxury market just watched a penthouse originally listed at $7.175 million sell for $5.7 million. That's a 20% haircut on prime real estate. But number 3, well, before I reveal that, let me show you what's happening with mortgage rates because this changes everything. Current rates are stuck at 6.68%, and the Federal Reserve just signaled they're pausing rate cuts through mid-2025. But here's the kicker. First-time buyers now make up only 24% of the market, an historic low according to NerdWallet's Q1 2025 report. Why? Because you need to earn $138,700 annually just to afford the typical Midwest home with current rates. Are you making that? Most aren't. But here's what the data reveals about inventory that should make every buyer pay attention. Illinois inventory is up 5.5% year over year. Michigan, up 11.8%. Indiana leads with a massive 14.3% increase. It's not just a blip, it's a trend that's accelerating. In fact, Columbus, Ohio now has 16.2% more sellers than buyers actively in the market. Indianapolis, even worse, at 20.8% more sellers than buyers. Now, you might be thinking, but I keep hearing the Midwest is hot. And you're not wrong, sort of. Milwaukee posted a shocking 20% price increase year over year to $330,000, according to Redfin data. But dig deeper and you'll see that even in Milwaukee, 20.8% of homes are reducing prices and homes are sitting on market 45 days on average. That's not exactly a seller's paradise, is it? Have you checked how long homes are sitting in your area lately? Because South Dakota homes now average 56 days on market, with Sioux Falls stretching to 83 days. Compare that to 2021 when homes sold in hours, not months. This is a fundamental market shift, not a seasonal adjustment. Let me hit you with something controversial that's going to ruffle some feathers. The Midwest housing boom everyone's been talking about? It's already over in most markets. I know, your realtor just told you it's a great time to buy or sell, right? They always say that. But Zillow's own chief economist, Skylar Olson, stated that the Southwest is expected to join the Midwest and the South as regions with markets favoring buyers. Translation: sellers are losing their leverage fast. But before we show you which specific neighborhoods are seeing the biggest price drops, understand this critical point about cash buyers. 1/3 of all home purchases are now cash, according to Washington Post data, and in Cleveland, that number jumps to 40%. These aren't regular families, they're investors, and they're creating artificial competition that's about to reverse. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like, subscribe, and share helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, let's continue. North Dakota tells an interesting story. Prices are up 7.7% year over year to $278,800. Sounds great, right? Wrong. They only have 826 homes for sale in the entire state, down 26.3% from last year. That's not a healthy market. That's a market running on fumes. Fargo already shifted from a seller's to a neutral market, according to local reports. When inventory finally loosens, which it will, prices have only one direction to go. But here's what the data reveals about seller concessions that changes the entire game. Nationally, 44% of sellers are now offering concessions to buyers, just shy of the all-time record. In markets like Indianapolis, sellers are essentially paying buyers to take their homes. Major builders like Lennar are spending 13.3% of the sale price on incentives, up from just 1.5% in 2022. That's not normal market behavior, that's desperation. Missouri presents a fascinating case study. The median price is $271,500, relatively affordable, but homes are averaging 46 days on market with increasing price reductions. Kansas City specifically is seeing homes sit for 19 days despite being one of the hotter Midwest markets. Have you noticed builders in your area suddenly offering free upgrades, rate buydowns, or closing cost assistance? Because they are, and it's accelerating. The real story nobody's telling you is about the rate lock-in effect. Millions of homeowners have mortgages below 4%, and they're not selling unless absolutely forced to. This artificial supply constraint is the only thing preventing a complete price collapse in many markets. But life happens. Job losses, divorces, deaths, and forced sales are increasing. Nebraska might be the canary in the coal mine with just 0.2% year-over-year growth to $307,600. That's not even keeping up with inflation. Omaha homes still sell in 9 days, but that's up from 5 days last year, and the trend is clear. Once a market stops appreciating, investor interest evaporates, and investors have been propping up prices for years. But here's what the data reveals about first-time buyers that should terrify current homeowners. Young buyers are completely priced out. The typical first-time buyer needs 18.6% of their income just for mortgage payments in the Midwest, the best ratio nationally. But that's still nearly double what financial advisors recommend. No new buyers means no price support going forward. Minnesota shows exactly what's coming. Median prices at $377,500 with 4% growth sound stable, but 33.4% of homes have price reductions, up from 29% last year. Minneapolis faces a Zillow predicted 1% decline over the next year. When Zillow predicts declines, they're usually conservative. Remember when they lost $881 million in 2021 because they underestimated market shifts? They're not making that mistake again. Have you considered what happens when the Midwest's affordability advantage disappears? Because at current appreciation rates, even affordable markets become unaffordable within 3 to 5 years. U.S. News projects exactly this scenario in their 5-year forecast, noting that sustained price growth without corresponding income growth is mathematically impossible. The investment angle reveals even more. Mom and pop investors with 1 to 5 properties make up 85% of the investor market, and they're heavily leveraged. When prices flatten or drop even slightly, these investors rush for exits, creating cascading price pressure. We're already seeing this in markets like Columbus, where investor activity is declining quarter over quarter. Ohio perfectly illustrates the bifurcation happening. Cleveland posts 10% gains while luxury Geauga County drops 17.2%. This isn't random. It's flight to affordability meeting reality in expensive areas. The luxury market always cracks first, and it's cracking now across the Midwest. But before you think this is all doom and gloom, here's the opportunity. 7 of the 10 most affordable metros for young buyers are in the Midwest, according to multiple sources. Detroit at $180,000 median, Cleveland at $217,000. These are entry points that don't exist on the coasts. Smart buyers who wait for sellers to capitulate, which is happening now, will find deals not seen since 2011. Wisconsin's unusual strength, particularly Milwaukee's 20% gain, is migration-driven from Illinois. But even this hot market shows cracks, with 20.8% of listings reducing prices. When the hottest market in the region has 1 in 5 sellers cutting prices, what does that tell you about the overall trend? The pattern is undeniable. Inventory rising, days on market increasing, price reductions accelerating, seller concessions at near record highs, and buyer demand weakening. This isn't a soft landing, it's a market resetting to reality after years of artificial stimulus. Fortune magazine literally called the American housing market in a deep freeze just last month. CNBC reports nearly 1/3 of major U.S. markets now see falling prices. Even traditionally bullish sources can't ignore the data anymore. Your move depends on your situation. Buyers should wait and negotiate hard. You have leverage now. Sellers holding out for 2021 prices are dreaming. Price it right or watch it sit. Investors should prepare for opportunities but expect volatility. The Midwest's fundamental affordability remains its strength, but the days of automatic appreciation are over. The market is speaking. Are you listening? If you found this video interesting, please subscribe, share, and watch this one as well.